That is correct. So recording in progress, that's very good. Welcome everybody. Good afternoon again to this Bergen Energy Lab. We had hit record already before, but it did not work. So it's working again and I'll edit this later. As I was saying, my name is Ignacio Herrera Anchustegui, and I am an associate professor at the Faculty of Law of the University of Bergen. And I work with different aspects of energy regulation. We were introducing before the event of today, and I apologize for being clumsy with the technology. This is normally how it does not work. Why is this not working with me today? And I'm being immortalized for being an idiot online, but that is okay. So now it's working fine. So as we were saying in the introduction before, formally welcome everybody again. So I don't have to edit so much on YouTube to this Energy Lab meeting where we will speak about the future of electricity markets. This is an event that is co-organized by the Norwegian School of Economics and the University of Bergen, and where we will have 3 presentations that are going to speak about what's going on in Europe in long-term and short-term electricity markets. And we have 3 great sets of speakers that we will be introducing later on as we will start. But first, I would like to introduce Professor Leigh Hancher. Professor Leigh Hancher has been working in energy markets and energy law for several decades already. Is an expert on these topics. She has a part-time position at the Florence School of Regulation, which is one of the hats that she's going to be wearing here today. She also has a part-time position at the University of Bergen, working with aspects of regulation of energy, and is based in the University of Tilburg in the Netherlands. And Leigh is going to talk to us today about long-term contracts and market reforms, because a lot of the market reforms is driven, as we will see on the second part of this webinar, on aspect dealing with short-term markets, but long-term markets are having an implication directly on the functioning of the short-term markets too. And because of this, it is a great opportunity for us to see what is going on with long-term markets and why we have so many elephants. So Leigh, I'll give you the magic tool here. That is working. You can come over here. And now you're live being recorded. The floor is all yours. Thank you so very much.
Thank you very much. Thank you, Ignacio, for the kind introduction. Thank you for the invitation to return to Bergen. As you've heard, I'm a lawyer and I've been working in the energy market area for a long time. And it's funny how you see the circle going round. When I started, it was all about market liberalization, getting rid of state intervention. And as I'll explain today, it looks like we're returning a little bit to that old model. And I've called this so many elephants because you might be aware of that. You might be aware of the English expression that there are lots of elephants in the room that we don't want to recognize, so we don't talk about them. So I'll try and highlight some of these elephants as I go along. I'm sure you're all aware that we have to meet an enormous challenge in trying to get to net zero by 2050. And we have a lot of targets that are produced by the European institutions, particularly the Commission. And the Commission has a habit of updating these at fairly regular intervals. So these are the targets that we're supposed to reach for 2030. And of course, electrification is very important in achieving the targets for emission reduction and energy efficiency. What's maybe interesting from the Norwegian point of view is the bottom line, the interconnection capacity targets. Can you all see them? They remain steadfastly at 15%. Since 2018, I think we've never actually got to 15%. One of the big questions, of course, and one of the elephants in the room, is whether we're going to really actually be on track to meet those targets, because, of course, we have to make great leaps forward especially in renewable production and in emission reduction to actually get there. So you sort of see the exponential increase is required to meet the targets, and it looks like actually we're not really on track for 2030, which is only, of course, 6 years down the road, but that will then have a knock-on effect on what has to happen going forward. We also have more specific targets. So this REPower EU plan that the Commission adopted in the spring of 2023 shows you a lot more detail on what we need. 2022, the plan came out. And so you'll see that we have very ambitious targets, especially for hydrogen. I haven't, of course, put our starting points, but many of you will probably know that hydrogen is, we're sort of nowhere near even 1 MT at the moment. What's been happening, I think, has been a lot of solar, but that's about the only sector where there is much progress. And here again, you'll see the steep implementation curve ahead of us. There's a recent report from the IEA, which I think is quite skeptical about whether or not we're really going to meet these goals. However, we do have these challenges to face. These are the elephants. And the first elephant is, of course, that we have to move very fast to mobilize the investments we need in renewable energy and in expanding and reinforcing grids. And just in the coming decade, we're looking at apparently 800 billion of euros in investment that we need. Now, the question of how to mobilize that is, of course, one of the big questions that's not adequately addressed. The second is that we have to retire a lot of fuel generation in Europe. And that is a big issue because that will mean that we will have to not only reduce that capacity quickly, but we will have to find substitutes to compensate not only for the missing fossil fuel capacity, but also because, of course, as we know, renewable energy being intermittent, you need adequate backup supplies. So we have to find a solution to that. And then, of course, the heavy industry, and electricity intensive users, they have to switch rapidly to renewables and stay competitive. So despite the fact, of course, that we're seeing prices they did rise a lot at the end of 2021 and continue to do so as a result of the Ukrainian war through 2022. They've stabilized a bit, but the predictions are that they will continue to rise. And of course, we have to look at global competitiveness. So this brings us to the subject of market reform, which I'll talk about very briefly. Some of you, I'm sure, are very involved in this, and you all probably recognize this person. And she declared, much to the dismay of her officials, that the current market design that we have in Europe is dead. It doesn't really serve purposes. It doesn't deliver for consumers. They don't get the benefits, and that we should be decoupling the dominant influence of gas in electricity pricing. And she announced that we needed a deep and comprehensive reform. So what exactly then is this reform meant to address? Well, the pricing issue, whether or not we should link prices, electricity prices, to gas prices. How do we deal with the price spikes that frequently emerge because of that link and will continue to emerge probably as we have more renewables on the system? How do we deal with a system that doesn't price in all the externalities, of which there are many, doesn't necessarily reward or stimulate investment, particularly in renewables, because it is so short term? So these issues have all led them to the launch of this market design reform, which was published. The first draft proposal was published in March of this year. And one of the themes that I'd like to address in that reform design is the role of long-term contracts. And we have to go kind of back to why we didn't like long-term contracts when we started to build the single European market. And that was because at the time, of course, we had a lot in Europe. We generally had sufficient extra or surplus generational capacity. We weren't worried about shortages. On the contrary, we were worried about incumbents with a lot of surplus capacity. At the time, of course, we didn't have third-party access in a very developed form, so it was very difficult for competitors to get into the market. There was a history of state control, and by dismantling state control, by trying to privatize the industry, of course, a lot of the position of those incumbent players was, as it were, replicated through long-term contracts. So there was a concern that these long-term contracts would be used to freeze the situation. And this would then mean that market foreclosure would occur. And this is where our treaty competition rules come in. So market foreclosure was a big issue. And we looked at long-term contracts from that perspective. How were these contracts closing out access to competitors to the market? Now, of course, this meant then there was a lot of discussion about long-term contracts, whole literature about these contracts dating back to the 90s. And the whole discussion was whether or not are they illegal under competition law. And the answer then and still is not necessarily. You have to look at their impact, their effects, and primarily we're worried about exclusion. So we're looking at tactics to exclude competitors from the market. And in a recent judgment, the European Court of Justice has made quite a useful distinction between when exclusionary effects are detrimental to competition and when they must be just considered as part of the way markets work. Some competitors are simply not efficient enough, and it's not the idea or the objective of competition law or policy to protect weak competitors. It should only protect efficient competitors. Now, of course, that's quite easy to say, but it's also a difficult test, of course, to apply. But what we've seen in the way the competition rules have been applied in the last 20 years is that the Commission has developed certain informal guidance as well as formal rules. And as we'll see, what's really important to determine whether or not exclusion can be detrimental to competition is the impact of market shares and whether or not the parties in the vertical relationship have market shares below 30%. Then we worry less, of course, and we still worry about the cumulative effects. So when one large producer, for example, has a whole network of contracts covering a market, then we have to consider whether or not this could lead to exclusion. We have quite a lot of case law. I think those who like reading case law, I've given them here. But these just, I don't want to go into all the details of this case law, but in general, what happened in these cases, they all concerned, if you like, the old world, old school bilateral physical contracts for the delivery of electricity or gas. And you'll see here in the way the Commission dealt with these long-term contracts, the emphasis was very much on avoiding market foreclosure, making sure markets stayed competitive. Those cases then didn't concern new investments in renewable energy. So we're in a different world when we were looking at these contracts, which were all reviewed when the internal electricity and gas market were just being created. And you can see from the dates. So these are all some 20 years old. So what you could see in that old case law when we were dealing with long-term contracts is that the Commission tried to be flexible. And we're looking at a lot of cases here where actually these are decided on the basis of commitments. So the parties negotiate with the Commission, and there's some toing and froing, coming and going, and in the end, then the Commission accepts commitments. So the Commission doesn't further prosecute the case. So here we see the emergence then of these limits on the number of years. So a long-term contract, if it doesn't go beyond 5 years, will probably not be problematic. However, if you're a reseller, if you have if you're also in the downstream market, it might be 2 years. You have to give the possibility for customers to get back to the market, so to be able to terminate their contracts. And in a way, then what the Commission is trying to do is to manage the duration, looking at different factors. So the extent to which the market is supplied by these longer term contracts, and dividing up, allowing 1 year contracts for 62% of the market share, and maybe 37% can be under 5 year contracts. So you can see that the Commission kind of messes around a little bit, massages the duration. But if the market shares then of the suppliers, in this case, for example, District Gas, the Belgian company, went over a certain percentage, then this was a problem. So what is interesting already in that District Gas case is that where buyers were investing in new power plant, new investments, they were exempted from some of these boundaries, if you like, on duration and the so-called come back to the market remedies. So you could tie them longer if you wanted a buyer to help finance a new investment. You also see a little bit of movement on vertical contracts, and we have, of course, if you know a little bit about how European competition law has been evolving, we have had a review of the vertical guidelines and the vertical block exemption. In the old guidelines from 2010, there was some flexibility already for longer term contracts, so that it was possible then to allow for a longer term contract if you could justify that on the basis of arguments related to the depreciation periods, so to encourage investment. So then you didn't have those limitations on the duration if you could justify that the investment would not otherwise be made. We have had then the recent update where we see more flexibility, where it's now allowed more expressly to even use non-compete obligations, so really tying your customers to you, if that will be necessary to address a hold-up problem for investments pursuing sustainability objectives. So you see here that these guidelines specifically mention hydropower plants and wind farms. These may all then need to require, supplier might only be willing to make those investments if it can commit a sufficient number of buyers to the project. So here you see then another move then in the way we apply competition law in the new market conditions where sustainability goals are very important. So you'll see then that in this case, these non-compete obligations may be allowed as permissible exemptions under the treaty if even the depreciation period in the contract will take you beyond the 5-year limitation. So long-term is becoming a bit more long-term if you are investing in renewable projects. However, what happens if you don't fall in this category? It's all very well if you're hydropower or wind or presumably solar, but if you're nuclear, for example, and you can imagine there are countries who worry about the future of their nuclear sectors, then they worry about why we get all these exemptions. Shouldn't we have a more technologically neutral approach? So this is an ongoing discussion. So just to maybe take a very quick step back and see where we got to with the application of the competition rules for long-term contracts by the end of the last decade. you'll see that what the Commission did was to concentrate really on the duration, often shortening duration, trying to limit the share of the market, customer market that was actually tied to the long-term contracts, and giving more rights to consumers to terminate. There are cases where the Commission actually prohibited certain clauses in contracts, very famously destination clauses, primarily concerned the gas market. About those types of contracts with destination clauses meant that trade between member states was restricted. And you have cases also where large players such as the Spanish company Repsol entered into a merger and was restricted from taking over new companies for several years. And you also see then the emergence of some quite novel approaches, like introducing virtual power plants and gas release programs, again, all designed then to reduce the foreclosure effects, to give competitors access to energy. So these remedies could all be combined. You can see in the district gas commitments, EDF cases, a combination of all these types of remedies. But I think the bottom line has really been that if you have a market share above the harbour, the safe harbour, from the vertical block exemption and guidelines, you have to really be very careful in concluding a contract up to 5 years, and 5 years really, I think, is the max. And you have to be prepared to give termination rights, and you have to be prepared then to really convince the Commission that these contracts are necessary for depreciation. What does it say?
5 minutes.
5 minutes.
10.
10, okay. Right. So that was just then the summary. I want to mention then that. In the meantime, long-term contracts have emerged as a way of providing public support. And unfortunately, energy law and anything to do with energy policy is absolutely littered with acronyms. We have a lot of acronyms, I'm afraid, on these slides, although I've tried to spell them out. So the contracts for differences are now very much the flavor of the year or the month. And we've seen the emergence of this type of public support, first of all in the UK, and it's now kind of spreading, and is in fact incorporated in the new market design proposal as the primary way, should be the primary way for states to give direct support to renewable producers. So the idea then is now that a lot of that support to renewable energy occurred through all sorts of feed-in tariffs, feed-in premiums, as well as contracts for differences. And this has all been assessed under the state aid rules. So you're giving price support to these new market entrants. And this has never been assessed under the competition rules. These types of arrangements have been presumed not to give rise to any antitrust concerns, because normally, of course, you are supporting as a state new entrants. So we haven't really looked much at the impact on the market of these state aid type supports. If you're a competition economist, you'll know that in state aid we don't really do much economic analysis. So we haven't really worried about the foreclosure effects of all this type of state aid support piling up. I think largely also because it's all been about stimulating renewable renewable producers who have been quite small players. So now let me go on to the new market design. You'll recall I said there were a lot of problems, and I've just listed them all again here from the previous slide, but in yellow I've highlighted why long-term contracts are now considered useful, because they're seen as a way of dealing with price volatility and as a way of encouraging financing in renewable projects. So they're seen Now, the solution. All the problems are created by the short-term approach, so it's only logical to try to resolve those problems by focusing on the long term. So that means that what we see in the latest version of the proposal that on the market design that was adopted by the Council as the common approach on the 17th of October and now go to the European Parliament, is that we have a very specific focus now on the need to use contracts for differences as the instrument. And we don't seem to worry about duration. That will depend on the depreciation period of the asset that will receive subsidy. For those of you who are not familiar with contracts for differences, the idea is that there's an agreed strike price and that usually a public sector entity, quite often a TSO, will be mandated to buy the electricity at that strike price. Most CFDs are what we call two-way CFDs. So if the strike price is too low, if the market price is below the strike price, then the producer will get a subsidy. If the market price is above the strike price, then the producer should pay back some of the profit. So the idea then is that the counterparty then assumes quite a bit of the price risk, where in a CFD, the volume risk still will normally stay with the producer. Of course, it's very difficult to be categorical about what CFDs are because there are very many models. But this is basically the idea which will be incorporated into most versions. Now, what's important is that although it doesn't have to be the case, but it is in fact in practice, so that for most of these contracts for differences, it's a state entity that will be the counterparty, not a private entity. Whereas if we look at the other type of long-term contract that has been very prevalent in backing renewables, developing renewables, that is the power purchase agreement, the PPA. And with a PPA, it's usually the private sector, private investors are contributing then to the development of renewable and renewable and low carbon energy deployment. So this is a quotation I've taken from the latest draft of the draft regulation on market reform, and the market reform seems to put both of these types of contracts in the same boat, if you like, that they're alternatives, and therefore considers that we can have both at once, and indeed we should have both at once to achieve our decarbonisation objectives. Now, the big question is whether or not the way this proposal is designed will actually deliver that objective. So we have a very fairly complex now matrix to change the environment for long-term contracts, and it's not possible in the few minutes left to go into all the details, but what you'll see is that in the new proposal, certain types of public support must take the form of CFDs. So they must be publicly backed. No more feed-in tariffs, no more feed-in premiums. You must use this instrument. And there's been a big discussion, of course, as to who should benefit from that type of state support. And there's now a big discussion about its impact on the market. And you'll have perhaps followed the big discussion between the French and the Germans when the French realized that this CFD instrument could be a way to really subsidize nuclear power and flood other markets with cheap nuclear. So the question of what can qualify for a CFD has been something that has been subject to debate. And the idea is that nuclear should only be backed with these CFDs, and hydro equally, if we're talking about new assets or repowered assets. Now, the idea, of course, is that the profits earned when the strike price is low and the market price is higher, these profits are redistributed back to the consumers. So this has also been something of an issue which consumers should benefit, only the consumers in the member state or a wider circle of consumers throughout Europe. So what we see then is now a debate as emerging as to whether or not this new perspective on long-term contracts should also require us to look again at that old competition mindset that I explained to you that we had in the post-liberalization days. And to try to achieve all these objectives, do we have to also think not just about contracts for differences, which will be subject to the state aid rules, the treaty state aid rules, but when we look at PPAs, are we going to make sure that these PPAs can still remain in the money? Will that still be an instrument that can be used? And that might require a bit more flexibility in the way we apply the competition rules, not least because there are a lot of flaws with CFDs and they cost a lot of money. So we have to really be careful that these CFDs will not crowd out private investment. So this is then going back to the elephants. I'll just sum up where we are with market reform and the elephants that are still lurking. Phasing out. So in phasing out fossil fuels, are we really facing up to how to do that? And in fact, the market design rules might actually be prolonging rather than shortening the phase out. That's because they will allow capacity market remuneration mechanisms to proliferate. I haven't been able to go into that. I'm happy to answer questions. That's another kind of long-term contract, if you like, with state support. Phasing in. The question then is, can we keep doing more of the same? Or do we really need to make a giant leap, especially when we're looking at storage and digitalization? And do we need to consider how we use our competition rules more effectively to promote that? And then the third elephant in the room, which I haven't dealt with, but which will be discussed, I know, by other speakers, is we cannot achieve any of our targets. We cannot make any of the RES targets if we don't have the investment in transmission and distribution grids. So there is a link between that elephant and these first two elephants, because what signals do we need to provide for the very long-term investments in grids to get that whole process properly up and running? So thank you for your attention. Happy to take questions.
Thank you so very much, Leigh, for your presentation. Beautifully delivered, and also beautifully delivered on time. And what we will do now is we have a little bit of time for questions, both in the room, but also digitally. That is one of the advantages of doing this. And we have about 10 minutes, if that is okay. We will eat maybe 5 minutes into our break, but we have half an hour. So if you have any questions, as you can see, Leigh is checking already if we get anything on the chat. But if there's any questions from you in the room, please let us know. And if not, Leigh, I will maybe ask you some couple of basic questions, because we have here quite a lot of students that are taking classes on either energy markets or in energy law. And I am also learning from you every time you give a presentation. And this market, okay, there we go. Back to the elephants. Good. And do we have any questions so far? Yes, we have one in the back, and I'll pass you the mic because that way online it's being heard too. And if you could introduce yourself as well, that would be appreciated.
Hello, my name is Florence, and I work for Eviny energy company here in Westland. And I have a question about this capacity flexibility providers and this capacity remuneration mechanism that you mentioned. Can you say something more about that?
Okay, I'll try. Thank you very much. I didn't get into the details on capacity remuneration mechanisms. For those of you who are maybe not familiar with them, because we have what we call an energy-only market, there's always been a big discussion as to, whether there's sufficient guarantees for new investment. And one of the ways that we have tried to give those guarantees is through these capacity remuneration mechanisms. However, and I think maybe if I can address your question this way, what has happened is that those mechanisms have largely been used to remunerate fossil fuel plants staying on the system, which is my first element. And it's been very difficult for member states to design those mechanisms to stimulate flexibility through demand response. Yeah. And in the new market design proposal, the Commission tries to tackle that criticism by trying to improve then the opportunities for demand side response and flexibility. Now, whether or not that will help, I think it's very hard to say. I'm not an economist, but from a legal point of view, demand response providers, flexibility providers have had a really tough time trying to market their products and compete in auctions to qualify as capacity providers. So we had a big case at the Court of Justice called the Tempest Energy case, where it was argued by the flexibility provider that a lot of the conditions to qualify for these auctions were not technologically neutral, and they just in fact discriminated against capacity flexibility providers like that. And it was a long and complicated case where the Commission kind of ignored quite a bit of evidence, so its decision was squashed, and then it went back. The Commission came with a new decision, and that one was eventually upheld. Meanwhile, this capacity provider had gone bankrupt, and the case was in fact taken over by an NGO client. But I think what everybody agrees when you look at those cases is it was very difficult to put flexibility on the same terms as the hard, electrons and molecules, for want of a better way to explain it. And that maybe member states were not, it was difficult to convince the member states that this demand response could provide the reliability and the security that they were looking for. And therefore, they always preferred to have, a power plant in the background. I think what the new proposals try to do is to say, well, we have to have a different way of looking at flexibility. There's one thing is resource adequacy, which was, the point I tried to make at the very beginning. We're not in a situation anymore of excessive capacity. We're in a situation where we're actually in many countries looking at capacity shortage. And one of the ways, of course, to really manage that is through demand management. And so we have to look at flexibility in a very different context. Also, because renewable power is intermittent, we have to really, make flexibility central. Which is where the other, this is really the other elephant in the room. We really need to force digitalization through to commoditize flexibility. Whether the proposals get there, most experts don't think they do. Because in the end, it's the member states, of course. I hope that answers your question.
Yeah, thank you very much. Very good.
All right. Do we have any other questions in the room or online? If not, I have a quick test for Leigh.
Nope.
For the students that are going to have an exam in not too long. See if I have learned with you and clarify. Do we have any questions in the chat? Not for now, right? So I have a couple of quick questions for you.
No.
So quick questions that I have for you is, when do we enter into one of these PPAs or CFDs, particularly the PPAs? Do we buy electricity, in this case, or gas, and we fix price? Or the practice is that the price is not fixed ex ante on the contract, and instead it is reflecting the price of the market. Because that is something that we hear sometimes, that it's being hedged, the price is pledged or connected to the intraday market, not the intraday market, the day ahead market. What do we buy when we buy one of those long-term contracts? That's something that I think is not clear.
Yeah, very good question. Maybe so if I go back to this slide. Of course, with a CFD, the strike price it's an administrative price. It's a price that is calculated based on modeling by a state authority. Now, what the Commission recommends is, of course, that where possible, you run auctions so that you try to get as a state the best price. And then, of course, you don't know what the market will do. So it could well be that the administrative price actually is quite low, and that you'll be obliged then always to pay any profit you make back to the state. So that could be a problem. So it's a fixed price, but if it goes up or down, the level of the subsidy support varies. With a PPA, if it's physical PPA, the price is fixed, but then you hedge it. You hedge it through financial contracts.
And can you explain for, I guess, half of the room here what hedging in this case is?
Well, that's just like a kind of an insurance. So it's you know, just like when you go on holiday and you take out insurance in case you miss your flight, or you're hedging against a risk. So you take out another contract and in the electricity market to hedge, to insure yourself against the risk that the price changes. You hedge also for weather, you can hedge for all sorts of things.
Very good points. I think clarified quite a lot on what a PPA is and what a PPA is not, and what a CFD is and what a CFD is not. And if I take from you, at least for my exam, and then the short takeaway that I take from this on long-term contracts is CFD typically is going to be a state, PPA is going to be private, but PPAs can have CFDs too. Yeah. So you can structure a PPA like a CFD in a way if you would like to. Yeah. Because that's where the magic of contract law comes in. You can decide a lot of things yourself. Mette, you have the last question so that we also move on to Magnus, that is going to be our next presenter. So give the word to Mette now.
I was wondering about the connections between these contracts and sort of the regular financial markets connected to electricity.
Well, it's a very good question. My rather basic view is that electricity markets, like gas markets, also are extremely complicated, and a lot of these proposals ignore that complexity. So the impact of these CFDs on all the different elements of the physical market for electricity is not really explained. When it comes to the financial, there is no discussion at all by the Commission at least, but there's a lot of criticism of the model because it will have an adverse impact on the financial markets. That's the crowding out risk, that it will really crowd out the financial market activities here. And so you see, the traders, of course, Euroelectric, are all very critical of this mandatory CFD approach.
So with this, we would like to ask for an applause for Leigh Hancher for her presentation now. Thank you so much for it. And now we go into our second presentation that will be now. Mette will introduce our next speaker, and I'll go and fix the practicalities.
Okay, so we thought that we had Manus Pandey from Statkraft to tell us a little bit about the long-term markets seen from the largest Norwegian electricity generation company. Yep. Manus has previously worked in the Ministry of Petroleum and Energy, I think. I don't know when you quit there, but then started in Statkraft. It's not that long time ago.
2020, yeah.
And then he's also been part of at least 2 of the committees and commissions, doing work on how to get more transmission and capacity in the networks in Norway, and also the Energy Commission, which we were part of the secretary. So please.
Thank you.
You don't need this.
No, I don't need that. I thought I'd say a bit of how this, all these investment signals, these long-term investment signals, affect a company like ours, like Statkraft. And I'll be picking up on a lot of those things that Leigh said, but I'll try to use sort of the economist approach on them. So hopefully this fills out some of the stuff that we presented already. Okay, so the reason I'm showing this about Statkraft is this number, because we already today we have 19 gigawatts of capacity. Our ambition is to have 2.5 to 3 in 2025 or 4 by 2030. Now, this is not about what Statkraft is doing, but it's about the fact that we are planning to invest a lot. That means that these investment signals affect our business, and then it's important to understand how do all these mechanisms and markets work. So that's why I'm trying to show you this picture. So we work a lot on these issues, both from a sort of regulatory perspective, but also from an investment perspective. I think this is another quote of the same, by Leigh. This was, I think, some weeks before the quote that Leigh showed, and I always like this quote because she says clearly it is no longer fit for purpose. Now, I don't think all of us would agree, but that was sort of there was a crisis, there was an energy price crisis, there was war in Europe. Of course, then we looked around, what are the effects of that? And it's not strange, yeah.
So people online are seeing the old presentation.
Oh.
So which one should I choose? Can you help me?
Yeah, that one.
This.
Yes.
Which one?
That one that you're clicking.
This one?
Yes. Strange.
Okay. They're still saying the old one.
How do you know?
I don't know.
Oh, they should be seeing that one.
Okay. I'll check on mine.
Okay.
So it's not strange that this was the discussion, but that the market is no longer fit for purpose. But it is at the same time, the current electricity market also handled the situation we're in. There weren't large blackouts, there were high price increases, but also you had consumption and production being affected and changing behavior, which is very often the point of prices. Okay. Let's see if I can. This is not working now. I can use this instead.
You can click on the screen.
Let's see. Let's see. There you go. So today's market design has a long history, basically from the late 80s towards the 90s and then going on. We've seen, parts of the electricity market reform in the EU was driven by the high price situation. But I'm not going to speak a lot about that. What I am going to speak about is the actual transition that the European economy and global economy is going through. And that is also why you've had a lot of the reform and why a lot of investments are being made, both in power production, but also on the consumption side. So what I'm going to speak about, I'm not going to go through this, but also the economic effects of contracts for differences, because it's a big part of the EU market reform. And luckily, Leigh has already said a bit about it, so I'm not going to go through all of this slide, but that is one of those things I want to speak about. The other thing is capacity mechanisms from an economist's point of view. So hopefully some of those questions will be able to be answered here. And as you can see, some of the most important question is, should they be temporary or not? And that was one of Leigh's points as well. And the other one, which plants, or more specifically, can coal-fired power plants actually be part of these capacity mechanisms? That is a big discussion in the European Union right now. And lastly, it's financial markets, because historically, power companies and consumers have used financial markets to ensure that their income, the prices they achieve, are at a level that they can carry their costs. So how do all these different mechanisms work together with the financial markets, and not least, are financial markets actually working as they should? And when I say financial markets, I'm not talking about interest rates, in stocks and shares, but I'm talking about the financial electricity market products. Okay, but to start off, I think what I want to do is say a bit about the electricity market, let's say as we know it, as the textbook sort of says, how does this work? Here we go. So we usually, as an economist, we often talk about free price formation and marginal pricing. So how are short-term electricity prices determined? Now, there are lots of production assets. These are all of these, and they all have different cost curves. For a wind generator, they use wind to produce the electricity. The wind is free, so on the margin, they only need to cover their costs of having some people ready to, the short-term, let's say, variable cost. So there's no sort of energy cost going in. The costs are quite low. Same goes for solar panel and solar production. On the other hand, a gas producer, or not a gas producer, but a power producer that uses gas to produce electricity needs to pay for the gas. They also have to pay for their emissions. Same goes for coal-fired power plants. And then you have demand, and very often, most of us, very often, we are willing to pay quite a high price for electricity. That means that this, this kind of, from this place to this place, the electricity we want to consume, well, we pay quite a high price for that. And then, of course, industrial consumers, businesses, they're not willing to pay everything or anything. Now, you might think that I've just been drawing this, and I have, but I did sort of check, does this actually look like reality? And I think it does, because this is sort of the actual bidding curves that are at Northwood. So it sort of reflects reality, and that is also an important feature in the electricity market. So, but if you have this situation, and the price is determined with supply meets demand, that's it. Who are these people that have been investing in these power plants? I mean, why do they do that? I mean, they don't achieve any price that is enough to cover their costs. The reason is, well, at all times, the wind doesn't blow at all times, sun doesn't shine at all times. Sometimes you actually need those power plants. So that's one reason. And I flew in from Oslo today, and it's been quite cold, and it's been snowing a lot more than usually in November. It's been quite cold. That's the other situation. Demand actually increases. It's not the same all the time. So in the short term, during the winter in Nordic countries at least, consumption is quite high. And also you have in other countries, consumption during the day is higher than night. So that might be another reason for those power plants to actually invest. But yes, as an investor, we're not only concerned about covering our short-run costs, because this is a short-run marginal cost curve. We also have to look at the long-term supply and demand, or our capital expenditure as well. And the reason I'm showing this is not because the reason I'm showing you this is that long term, when we are investing, we're sort of looking at what is the cost of investing in this asset. And we need to look at the capital expenditure and the short-term cost, and what is the long-term average price. And I'll be using this later on to discuss a bit of the effects that different mechanisms have on different projects. Now, one important issue then is that, from the previous slide, you have these, right? You have very low marginal costs. So those might as well be the same one with high total expenses. So wind power, offshore wind, for example, is very low marginal cost, high capital costs, and overall are high on the right-hand side of the scale. So as an investor, you need to sort of calculate all your costs. The other thing you need to be quite sure of is actually that it's not the average price that is important for you. the average price is just an average. What you don't want to know is that this is wind production in the Nordic countries. And as you can see, the wind production changes a lot. So as an investor, you actually, you want the price is high here, but you're not actually producing any volume. It doesn't really help you. You want to have high prices there. So you need to have good information about your volume and the prices. And you see, this is just 1 week. This is that week. No, I think, yeah, it's the last week, week 42. You can see this is going up and down, up and down, up and down. So, what the average price is not actually that important for you. It's your achieved price, what are the income that you will achieve. So now I've sort of gone through some of the basics of how we as an investor look at projects. We need to figure out all of these things to be able to invest in a project. And of course, the income side has to be higher than the cost. I think that's the simple and basics of it. So in this world, and it was quite a simplified world, how do all these different support mechanisms, for example, for renewables work? So I think I'll start with the contract, the background for having all these support mechanisms. Because in the previous slide, I showed you, well, we're getting the investments that we need, people will invest and so on. Obviously, that's not true. Like Leigh already showed you, there is, you have the 54-55 package that had some ambitions about how much renewable production Europe should have. And that has been strengthened in the Repower EU package. And now there's an ambition of 45, or aim of 45% in 2030. So, and what are the mechanisms to achieve this? One of the main mechanisms is support for renewables. And as we showed in one of the first slides, contracts for differences are the main tool that the EU Commission is proposing. So they're saying, no, we're not going to have other support schemes that give you short-term support or support for your daily cost. You might get investment support, but for the sort of per kilowatt hour that you produce, there's only going to be one kind of support scheme, and that's going to be a two-sided CFD. How do these work? Just like Leigh said, you have very often an auction. So you have an auction amongst a set of very often one kind of technology. In Norway, we had there's going to be an auction for offshore wind. So that is designed as a two-sided CFD. So there's an area and there's one technology, and you say who can actually produce electricity here at its cheapest cost. The auction winner is the one with the lowest price, and that's what we call the strike price. And that means they have a fixed price contract with the government. So as an investor, you get a fixed price from you've secured a fixed price, and that's what we call the strike price. And then comes the beauty of the two-sided CFD, which is that, well, you will still be selling your production in the market. So and here is what we call the reference price. So if the market price is lower than the CFD, we'll be getting this in the market, we're selling it in the market, and then the government will be giving you this amount. But the government is paying you just the difference between what difference between what you're getting in the market and what you've already, let's say, agreed on the auction price. The other reason why it's called two-way or two-sided CFD, so, well, if the market price actually is higher than the strike price, you're paying back. So one of the reasons why this mechanism is favored, over the other mechanisms is that, well, the government at least knows that this is, or the government knows that if the market in itself actually manages to pay these, the market in itself is above the strike price, at least the government then wouldn't have to pay. Because if a feed-in premium, which is an addition to the market price, even if the market price is high, you're still paying an additional premium. So this sort of stops that situation. But then there are other issues with the contracts for differences. And I'll go through some of them now. I don't know, Any of you seen this duck curve? This is an American thing, but it's not an American thing. This picture is from California. So here you have megawatt hours, which is the load or how much consumption at a specific time is there. And then what's important is that it's net load. So it's the load minus residential production. And that is very often solar production. So what you can see here is that as solar production is increasing, the net load is decreasing. So that means, so most of this, if we assume that, the amount of people is somewhat the same, how much electricity we use is somewhat the same, this is when there's a lot of solar production. Now, if you already have a fixed price, but you don't have a fixed volume, when, if you can install your solar panel, at what time of the day will you want it to produce, be able to produce the most? But do you think it will produce the most? Probably in the middle of the day. Most sunshine is on the middle of the day, and you get the most of maximize your volume, you already have fixed price. The value, if you could at some point, some way, install solar panels, but the solar panels that would actually have production in the evening, in the afternoon, maybe they can be put in some sort of an angle. We see that there are companies doing that, then perhaps the value for society will be higher. But the CFD, if you have fixed price, actually gives you an incentive to maximize your volume. Because you're getting paid a fixed price and you're getting paid for all the volume that you produce. So that's one of the pitfalls of a contract for difference. So it does skew some incentives. The second one, and this is perhaps why I wanted this this chart, is that, well, the CFD may also displace commercial products. Here, this is the same picture that you saw earlier. Long-term price, the clearing price, is at this point. That means that these projects, and perhaps only half of this project, is actually being built. Let's say you have an auction and you want only this technology. Let's say H is a separate technology. H thinks that, well, if we enter the market, the price will become at this level. That means we'll need that much of support. Because, this part is the support, and this is the overall cost. So what happens when this H wins in the auction and is built? Well, it's getting that much support. It'll be, coming in at this point. That means all of that E project going out parts of this D project as well. So it displaces other production. And that is another pitfall of contracts for differences. But it's not only contracts for differences, it's basically, this is the effect of subsidies. Now, does that mean that you shouldn't do it? Not necessarily. But it is, when assessing whether the value of bringing in the H project into this power system, you have to also consider the other two side effects that I mentioned. Okay, and then I think I'm speeding quickly, so I'll talk a bit slower. Then the capacity remuneration mechanisms, and I always take away the remuneration part because it's very difficult to say, but Leigh already said it, so I guess I have to do it as well. The capacity mechanisms are quite important as well to understand. Now, as Leigh said, capacity mechanisms are about production that can be there when you want it. So typically, renewable production that is based on intermittent technologies like wind power, solar power are not eligible. Now, why does Europe really talk about capacity mechanisms? One reason, and this is from the TSOs, so I think the one knows even more about these things than I do. This is that, well, if you don't have capacity mechanisms in 2030, this is the amount of time that you actually don't have enough capacity to meet demand. There will be hours where hours per year that you'll have a loss of load. How much load, I'm not sure, but there will be some load that will not be met. So that means that's quite a new situation. people will be wanting electricity and it won't be provided to them, even if they're willing to pay a price. So what is sort of, and this is one of the main issues driving the discussion of capacity mechanism. This is the rationale behind why, a regulator or government is trying to introduce these. And these are three of the reasons very often quoted as for saying why you need capacity. First one is that renewables are depressing the energy prices, and we saw that. And I'll give you an example of that. Second is one thing that's often called missing money, but there isn't enough money in the market to actually invest in these things that, I showed you TSO says what. The last thing is that scarcity pricing is politically hard. That means that politicians will not let prices go high enough to actually, make these investments happen. Let's see. The first one. So the question is, renewables are depressing energy prices in Europe. As we saw in one of the first charts, remember, price was quite low. I put in more renewables here, it's a low marginal price. The demand is the same, so this is the price. So, no one will invest in these things, but there will be some hours when you will need them, right? Because you know that there are hours when renewables will not be producing. And if these hours are too few, perhaps nobody will actually take the risk of investing. So that's one of the ways to, arguments for having capacity mechanisms. The other one is, you might remember in the start I said, well, this is only the short-term marginal cost curve, right? And this is, so even if you're getting that price, what about your capital expenditures? You're not getting them covered. You'd actually want this and a little bit more premium. But if you're taking a premium, and the last one, competition law experts will say, oh, no, you're not allowed to do that. So perhaps there's a missing money. These are expensive, flexible assets that are not getting covered their costs. That's why maybe you need a subsidy for them as well. The last one is that, well, there might be politicians saying, wait a minute, we can't have those prices. They're way too high. Our maximum price will be here. And as an investor, that means you're not going to invest. So if that's the maximum price you're going to get, and your cost was up there, that's not really, it's not really investable. And what happens then? We have this much production. Demand is here. Wait a minute, there's what you call a loss of load. Supply curve and the demand curve doesn't know what to do. How do you get all these investments? That's at least the reasons for going for capacity markets. So let's say you are an investor in flexible assets, and you see that this discussion is going on. What will you do? Will you invest merchantly? Will you invest, on the basis that prices will be high enough? Is there anyone who would invest? No investors. Well, I think, when capacity markets are introduced or are discussed, it scares off some investors, because if you wait, then there's a mechanism, you might get a subsidy. So the discussion about capacity mechanisms themselves might affect the investment decisions. So why is that? What are you afraid of as an investor in flexible capacity? Well, it's the same as we said about the CFDs. And I've just put in the same picture. Let's say H is the flexible capacity now, not the CFD capacity. And that will come in. Well, at that point in time, if you were a merchant investor in E, you shouldn't invest. Price will be too low. And that's why it's good, so as an investor, you might want to wait. So, because capacity mechanisms require eligibility, right? Because you only want those who you are sure of will be able to produce, and when it's either when it's called upon. So maybe when the wind production is low, solar production is low. While market signals, what we said, when you have free price formation, market signals are sent to everyone. So if somebody has, a very good idea of new production, if they go into the market with a free price formation, they'll be able to get the returns. While the capacity mechanism that requires eligibility will often look at, well, what kind of capacity is there? What kind of, you have gas-fired power plants, you have hydropower plants, and Statkraft has lots of. You have coal-fired power plants. You don't look at the power plant that doesn't exist. So that has a bias towards existing generators. And then, as Leigh said, demand side is, of course, how would they participate? Me personally, I wouldn't be able to participate, even if, if the price was right, perhaps I would, turn off some of my heaters, right? I mean, and if many of us do that, well, perhaps this capacity issue is fixed, and maybe it's cheaper for society than something else. So all of these issues, these are issues with capacity mechanisms, and they're quite similar to the issues of contrast for difference. And now, the other issues, of course, when you have a CFD, but also when you have capacity mechanisms, how much capacity do you actually need? Who decides on that capacity? In regular electricity market, it's based on how much electricity we use. How do you determine future capacity? How much do you need? Well, somebody centrally is going to calculate that. And as Mette said, I used to work for the government previously, and I know that governments are quite risk averse. So we're quite sure that we have enough capacity. That's the whole point of the capacity mechanism. I'd say there's a little bit bias towards having too much capacity rather than having too little. That's, of course, another issue. The last one is, are you having a national view? I mean, I think it's around end of January. It's the cold day in Norway with the highest consumption. And I'm quite sure that the day with the highest consumption in Sweden, probably some other day, around the same time. And in the UK, it's probably some other day. So if you look at, if Norway has capacity for our maximum consumption, Sweden has the same, the UK has the same, probably we have too much. So you're adding all the different days with the maximum consumption on top of each other. So when you're designing capacity mechanisms, you need to at least look into what are these different countries doing as well, neighboring countries. And that can go both ways. If your problem, your hardest day is at the same time as your neighbors, then you can't rely on your neighboring country to deliver electricity. So there is that side as well. Then the other side of it is what I explained. Very often, the problematic times might not happen at the same time. And now I'm going into the last one, which is a bit different than two previous ones. Now, the two previous ones about subsidies in a sense, and there are good arguments for having them, but there's also good arguments against them. Last one is risk-reducing mechanisms, and specifically financial markets and long-term hedging. I'd say there is a very good reason for having possibility for risk reduction in themselves. The reason is, let's say you are considering to invest in a solar power production plant. So your price outlook is promising, but there isn't risk. That duck curve might happen. You might see very low prices, and that means your investment is unsure. And looking at this, you've seen electricity prices vary quite a lot. You see, there's lots of variability in the prices, and perhaps you will not be able to actually, carry all your costs. You'll have, buying the solar, doing the investment, you're paying your debitors, and you're paying on the debt, and you're paying the people who are working there. And you need some cash all the time to actually, be able to carry on. So what you want to do is secure your price at some sort of a sufficient level. It might not be that important for you to be able to, get that price. But what you don't want is to have those prices which are negative. What do you do then? Well, you can use commercial risk-reducing instruments. Then you have the non-commercial risk-reducing instruments. So commercial risk-reducing instruments are what we call, very often so-called long-term PPAs. Now, we already discussed a bit about PPAs. From Statkraft has a long history of providing PPAs. In pre-1990, those were government-backed PPAs, government-issued PPAs. Now, because of that history, we can, design PPAs with power-intensive industry. Now, I'd say PPAs are very often tailor-made products. So it's a contract between Statkraft, the producer, and some power-intensive industry. We'll usually say, well, we'll provide you with a fixed power price. The actual power that you use, something you'll have to buy at the day-ahead market, just like everybody else, and we'll pay you the difference. So it looks like the contract difference, but is between two sort of competing parties, or two private entities. Now, so that's one way of doing it. The other one is through futures and forward markets. Those are very often less than 5 years. And those very often can supplement these long-term PPAs. The reason for, and I'll come back to how they can supplement each other. And then there might be different instruments, etc. Because this is open and free market, and you can actually design these things just the way you like. One way, for example, for PPA is that it might not, the power price that you agreed on might not be fixed. It might be actually pegged to something else. Let's say there's a producer of some material. Perhaps they would want their power price to, their contract to fluctuate with that material price. Well, perhaps we can provide it, perhaps not. But that, it's sort of a free, you're free to arrange those contracts in which way you want. And then I've added these non-commercial risk-reducing instruments, and that's because contract for difference is, in a sense, a PPA with the government. So if you've gone into a PPA with the government, why would you want to go into another PPA? You wouldn't. So it fulfills the same sort of need, at least for the producer. But the counterparty is the government and not actually a power consumer. So it sort of takes away liquidity from sort of the commercial side and for the consumers. So this is the second case. This is trying to illustrate why these sort of long-term PPAs work together with these financial short-term instruments. Now, the long-term, let's say you are you're the owner of a manufacturing plant. You're manufacturing some product and you use a lot of electricity. So what you've already done is go into a 10-year contract, a 10-year electricity contract. Now you say, well, next summer, we want to rebuild our power plant. Industry is booming. If we rebuild, we'll be able to produce a lot more. That means in that 3-month period, you'll be closing down your production plant. Now, you're closing down your production plant, but you already bought electricity for all the next 10 years. This is happening next summer, and you're afraid, wait a minute, we're in Norway, it might be a wet summer. There might be, the prices might become too low. And then when we're sitting on that contract and we want to sell back the electricity, we don't know what value that electricity might have. So before we start that rebuilding thing, let's just sell this electricity already, a year ahead. You don't want to sell it for 10 years because you're going back again. You need some short-term product. You need something that's shorter than these 5-year plus contracts. That's where the financial markets come in, because they are, as I said, short-term products. I think the longest sort of liquidity is around 7 years. You have your weekly products, monthly products, and they're standardized. And that means that they're standardized, and you're actually not knowing who the buyer is. It might be consumer, it might also be another producer. Doesn't really matter. So they're a lot more standardized, and in a sense, they provide a different kind of flexibility than the PPAs, who are tailor-made for a certain consumer. In Europe today, you have, in a way, 2 different kinds of financial markets. One, and this is taken from EEX, which is the largest, what do you call it, power exchange in Europe, providing forward markets. What they say is, well, you can trade in your own bidding zone. So they have a price, a long-term price, in your own bidding zone. Then you can trade, for example, in different bidding zones, but you're located in France. You're trading long-term in the German market. Presumably because those two prices are very often the same. And then you need to combine these things, and that is, in this model, done through so-called transmission rights. And I'm not going to go into that, but that's a financial product that's aimed at least at to handle the price differences between these two countries. But very often as well, they're not necessarily used for hedging. Very often they might also be used for risk taking, but still they can provide a hedge. And then you have the way you do it in the Nordics, which is, well, we create a system price. System price is the price that nobody actually sees. It doesn't exist in a sense. It's a theoretical price saying that in this area, if there were no grid constraints, you send electricity exactly the way you want it, what would be the price then? Well, then you can trade towards that price. The reason for that is then all of these actors are in that same market, lots more liquidity, and lots more liquidity means that there is a larger chance that you're actually able to see a price that reflects the future market outcome. And then in this market, you have something called EPADs, and I'm not going to go into that because that sort of covers the difference between this area price and the system price. These are sort of two main models of financial markets in Europe. The European Commission, and I think, you know, I think this is quite complicated. I usually think of myself somewhat of an, you know, I know a little bit of electricity market. Now, when the EU Commission is looking at what to do, they've said, well, you should have virtual hubs, which points towards a system with a system price, sort of the Nordic model. At the same time, they say it should be provided through long-term transmission rights. It's this thing. It's sort of talking about both of these systems at the same time. It's quite difficult to understand, well, how does that actual system financial markets then work? And that creates some fear for people or companies like Statkraft, because as I showed you, the financial markets are quite important for us to handle our risk. What we've seen is that the liquidity in the NASDAQ, in the financial market in the Nordics, has been declining heavily. Some of that decline might be perfectly fine, you know, because there is, in a sense, no perfect, you know, what's the right size, what is the right liquidity in this kind of market? Some of you might know that, you know, at least in Norway, I think in the Nordics, the consumption of electricity is around 300 terawatt hours, something like that. Around there, yeah. So of course, this liquidity could be a lot higher than that. So what's the right number? I don't know. But what you know is that it's declining. But of course, the fact that it declined because of Enron is perhaps not a bad thing. Then you have the financial crisis, and you had requirements for bank guarantees. Or bank guarantees were no longer allowed. You had to come in with cash yourself, so that would use liquidity. Then the strengthened compliance agreement, the requirements, that's quite a good thing, and so on. And what you see though is that slowly, as time goes, the liquidity in these markets has been reduced, and that makes it difficult for investors in power production or power consumption to hedge our risks. And then in the end, I've added the new Norwegian tax regime. I'll come back a bit to that. That's the last point there. So in these, let's say, in these markets, long-term markets, or the financial markets, what we see at least is that, you know, other interventions affect them. So as we said, CFDs, for renewable, if you're investing in offshore wind and you go into a CFD, you manage to have a fixed price. You won't be interested in selling your power production in any other contract, unless, of course, it's the CFD is designed so that's only parts of your production and so on. Another thing would be, of course, that capacity mechanisms do the same thing. Getting a fixed price, that's quite fine. Or so that will have an effect, might have an effect on financial markets. The last thing is that you might have so-called asymmetric taxes. We saw that last year, and that was what I meant by the Norwegian tax. So let's start with the EU. In the EU, as a short-term measure during the energy crisis, they said, let's have a revenue cap on electricity producers. So let's have, if the income is above a certain level, you'll have to, member states have the ability to tax that. That's understandable and it's fine, but it does create an issue, because if you've hedged your price at a lower level and then the spot price is quite above this revenue cap, well, you still have to pay a tax. What you've done is fix your price at a low level. That's a problem. So revenue, let's say income caps or revenue caps can, asymmetric taxes make financial hedges difficult when you exit the market. In Norway, we had a similar thing, which is now not in existence anymore. It was a high price contribution, as they called it. That was at a certain point when the price is above, I think it was 70 øre per kilowatt hour, you'd have to pay in total, if you add all the taxes, 90%. While if it was below, I think it was 67. So if you, that means that when the price becomes very high, and if you've gone into a financial contract, then you might end up paying a tax without actually having the income. So what do? You do not participate in any financial markets. You exit that. And so the liquidity in these markets had gone down, and that has, of course, a negative effect on investments or investors' ability to handle risk. That was it. This is the archive. I'm not going to use all of those slides as well.
Thanks a lot, Manus. Questions from the audience here first.
Hi, I'm coming from Statkraft Energy. I have a question. So you talked about the CFDs, and for me, it's kind of like a redistribution of wealth of the project with the CFDs. And before that, they had like feed-in tariffs. Do you think that the new reform, like the CFDs, the capacity mechanism, will affect future investments, because we need more investments in renewable energy in order to decarbonize the market, right? Do you think that this will happen? And we have seen like tons of investments in the last 10 years, for instance, in Germany. Do you think that it will slow down the reform, the investments in renewable energy and other products?
No, not really. I mean, I think, EU has strong ambitions about renewable production, and we've seen in the last years that they've been able at least to have a high tempo, maybe not, if they'll meet their ambition or not, at least there'll be, quite a lot of investments in renewables. And I think that is quite clear, and they're doing a lot of things about permitting and so on to ensure that lots of investments are being made. And CFDs might be as good an instrument as the other ones. The issue is, of course, that you might get lots of investments, but you might not get those investments that are the most efficient. And that's a different question. And that was what I was trying to, show. So it doesn't mean that you're not able to get those investments or not be able to get investments in renewables. I think CFDs are aware, you auction, there's an auction for capacity and you're paying a price. And if you're willing to pay that price, you will get those investments. And then, of course, there's a second question: will governments want to spend, increase costs, etc., and all those questions? But CFD as an instrument I don't think it will differ in a sense. And it is also right, as you said, that CFDs might be seen as a redistributive instrument. But I think we shouldn't, in a sense, overplay that, because the idea is that the projects that go into such an auction are looking for a subsidy. If you think that if you achieve the market, let's say if you can choose between the market price and the strike price, and you believe the market price to be higher than strike price, and that, so if you go into the scheme, you'll have to pay back to the government. You won't go into the scheme. You'll do it merchantly. So the CFD is primarily a way to subsidize, but it has sort of government has a sort of hedge, so they won't have to pay too much. But it is a subsidy scheme. That's the most. Yeah.
Can I ask you a question? Are there any questions in the chat?
I think there might be. Or...
I have just one clarifying question, and that is are the CFDs really a fixed price contract on whatever volume you produce?
Well, you can you can design these things in different ways, but normally it is a fixed price for the volume that you produce. But then TSOs have been discussing maybe you could have sort of capacity savings. They're not actually based on volume, and that could solve some of those issues. Yeah, absolutely. But that's not been the sort of normal way. And sometimes I've seen sort of illustration of the strike price not being one price and being being two prices, but I haven't seen that in practice. So I've just seen that in illustrations.
Okay, we're going to have a short break, so please be back at 2:15.
Dette var superinteressant, Manus.
Ja,
Tusen takk. Og det var så bra forklart.
Ja, bra.
Du må komme her flere ganger.
Ja, så bra.
Jeg setter veldig stor pris.
Ja, nei, så
Og jeg tror det funker. Hva skjer er at hvis du ikke klikker her, det stopper å funke.
Ja. Men det gikk jo helt.
Ja, det har jeg.
Okay, I was muted. Thank you. Yeah. Yeah, this is just like the regular Teams meeting, right? You see someone mouse is moving on. Hey, you're muted. Seen it all before. So yeah, basically, we can move forward. So the long-term time frame, that will be products for a year ahead and month ahead. So that's where it all starts off. And the TSOs, or the system operators, part in that is basically to provide capacity, right? So when you trade transmission rights on the border, you need the capacity to trade on. So the system operator is providing the capacity. And with capacity, with the current transmission rights, that's also the product. It might change in the future, but there is a capacity calculation, there's a submission of bid, and there is an auction platform that takes care of the trade. And that setup is basically going on in all the different types. So now we're moving from the long term to the day ahead market, which we call a spot market, or day ahead market. In the day ahead market, we trade energy, or not we, but the stakeholders, the generators, the consumers, they are trading energy. And energy, that means that you have a capacity like a megawatt, that you sell a megawatt over 1 hour. So you have a megawatt hour. That's an amount of energy. So that's an energy market. In this market, which is regulated by what we call capacity allocation and capacity management. No. Capacity allocation and congestion management guideline, which is a regulation guiding this market from the European Corporation. The power is traded 1 day before delivery, right? So today at 1 o'clock, we got the prices for tomorrow. So basically the trade happened between 12 and 1. Here we give capacity. The system operators provide capacity, and those capacities are submitted to the European auction platform, which is called PCR is one name. Euphemia is the name of the algorithm that is running the market. Stakeholders submit the bids, and the auction clears the market. And when the market is cleared, it is cleared by net position and price. So it's cross-border trade. That means that there are trade inside each bidding zone. But what is cleared in that market is basically the net position. That is generation minus supply for each bidding zone. So you have the surplus in each bidding zone. That surplus is being traded towards another bidding zone or somewhere else in the system. So the solution to the market problem is net positions and prices. A lot of changes is coming also here to the day ahead market. First and foremost, we are working on implementing a flow-based system. I will come back to that for the Nordics. The flow-based market coupling system is already implemented in Europe, in core, in most of Europe at least. But at the same time, we are also working on a new market time unit, which is 50 minutes. So instead of trading 1 kilowatt hour or 1 megawatt hour, in the future we will be trading 1 megawatt quarter or 1 megawatt kilowatt quarter. Basically, it's an amount of energy and affect the capacity sold for a certain amount of time, which is 15 minutes in the future. And the complexity that is going on inside Euphemia, seen from a theoretical point of view, it's very easy, right? And you have a supply curve, demand curve, capacity, you trade between them, everything's nice. But in reality, Euphemia clears 24 hours at once. And you have non-convexities, which are startup costs that must be handled. That means that if I sell a megawatt hour in the first hour, I have much higher cost than if I can sell the same megawatt hour over 2, 3, 4, 5 hours, because my startup cost is being kind of leveled out over time. So we have block dates as an intertemporal element inside those 24 hours. And you have not much flexibility all the time. So you have price insensitive bids. which was shown earlier today, that the supply, the demand curve is basically straight down. So it's a very, very difficult numerical problem to solve. And moving from an hourly time resolution to 15-minute time resolution is an enormous problem for the algorithm. And initially we have, I think it's 10 to 17 minutes we have each day to clear the whole European market. We can't do that with 15 minutes. The complexity is simply too much. So there has been an intensive work on the Euphemia market algorithm the last couple of years. And it seems now that we are able to solve most situations within 30 minutes. So we need a little bit more time for the algorithm to work between the capacity being provided by the TSOs and to the submission of the market clearing result to the after this has been submitted. So this one has been really, really hard to solve. At the same time, there are the discussion of co-optimization, which we system operators don't like, and the PXs, the NEMOs, don't like it, but the regulators love it. So we have to do something to see how to implement co-optimization. What is co-optimization? Well, co-optimization is where you move into this time frame, which is the real time frame, and we have to procure balancing power capacities in case there are some deviations between supply and demand in real time. So we need to make sure that we have reserves, whatever happens. So if you take this market and put it into this market, we can buy reserves at the same time as we trade in day-ahead products. And that is also problematic because when we buy reserves, we don't actually activate them. We only activate them in real time. So there are some issues about, well, what prices should the TSOs provide for that trade? How do you take care of the fact that you don't activate these stuffs, but it will apply some of the transmission capacity here, but it's being activated down there. So we don't really know what kind of transmission capacity will be used. This is a huge thing. We are trying to fund it off a little bit to say that, okay, let's do the 15 minutes first because it's complex. Let's do flow-based first because it's efficient and we need it. And then we can talk about optimization later. Regulations aren't that easy always. So we clear this market, day-ahead market. Our time is running so much faster than I imagined. Then we move to the intraday market. And the intraday market is also guided by the CACM regulation. So in the intraday market, physical power is traded continuously until 45 minutes before real time. So if a balancing responsible party can see that, oh, the wind power I planned for isn't coming. So then he can apply the intraday market to trade himself into balancing. So he can be sure that whatever I have traded in the market can be delivered in real time. This is a continuous market. Basically, you have trade by trade by trade by trade. So you don't clear it in a big auction. But the market participants can move into a platform and they can see what kind of energy is available for trades and they can pick that bid basically. Then they can come out of the 45 minutes before real time in balance, basically. Also in this market, we will have some changes. And I think that the most important one here is basically intraday auctions. So we are working currently with implementing the auctions. They will come along. I think somewhere next year, we will start having intraday auctions. That will be 3 auctions during the day. One at 3 o'clock, right after the spot market, for the first auction. And then the market turns to continuous trade again until the next auction, which is at 10 o'clock in the evening. And then it turns to continuous trade again until the third auction that will be somewhere 10 o'clock in the morning, something like that. So we have 3 auctions and continuous trade between those. We are also working on implementing this flow-based approach for the intraday market, both the auction and continuous trading. The intraday auctions will be run by the same algorithm as the day-ahead market, which is female, and the continuous market is run by another algorithm called XTrade, the name of it. And we will also change to 15 minutes in this market. So the last market time frame is the balancing market. That is run by a regulation called Energy Balancing Guideline. Surprisingly, in this market we are procuring activations, basically activations of real-time energy to make sure that the system is in balance all the time. So this is kind of a it's kind of two markets in one. There is one market where we buy reserves, and then there is one market where we can activate those reserves. And the changes coming here is basically in the end, ultimately there will be a flow-based approach, but that is far, and one more far into the future. So this will continue as an NTC market. But the thing that is coming is 15 minutes of time resolution, and also some new European market platforms. Those are called Mari and Picasso. And in the Mari platform, we will trade in manual FRR reserves. I will come back to that one a little bit. And in Picasso, we will trade something called automatic frequency restoration reserves, AFRR. Let's see. I'm a bit of slow. Am I so slow that this one has just given up on me? Click again. Okay, that's it. Yeah. So I want to dive into this one. I don't think I have much time to do that. So this is just an illustration saying that the actual physical grid is complex. The grid seen from the market point of view is simple. So we have to simplify this information to match that system. Very quickly, today we have an NTC system, net transfer capacity. That means that we system operators provide capacity to the market platform based on a certain principle, namely that there is a certain capacity for trade between two bidding zones, and we have to provide that capacity between all bidding zones. But when this information comes to the market platform, it doesn't see this one and that one. Actually, it doesn't care about that one when it comes to the market equilibrium. What it cares about is the sum of the capacity for export and the sum of the capacity for import in each bidding zone. So net positions and prices that fits with the sum restrictions. Then there is a post process that will give us flows on those interconnectors, but that's not physical flows. It's something called schedule exchanges. It doesn't match the physical flows in the network. So the current system works in this setup like this, and I know that the physical system works in a way where the physical flows will deviate from what you plan for. So when I give capacity on this line, for example, that means I want to see what capacity is there for trade from A to C. I also have to take into consideration that some of the flow will traverse. Oh, I had a pointer. Nice. Some of the flow will traverse through B and then to C. So when I give capacity from A to C, I need to take into consideration how much flow can there actually be from A to C at the same time. If there's a trade from A to C, it applies some of the capacity here. So when I give capacity from B to C, I have to take that into consideration. It means I can't give full technical capacity. I can't give full capacity. I have to choose something else. So I have to make sure that my system is secure. If I give full, if I would give 1000 megawatt on a 1000 megawatt line like this, then I would risk that A would generate 2000 megawatts sending it to C, because A has 1000 megawatt here and 1000 megawatt there. But I know that most of that power will go here, gives me an overload, the grid breaks down. So I have to change and reduce the capacity somewhat to be same with NTC. In the future, hopefully next year, much sure about next year, last part of next year, we will move to flow-based. And in the flow-based system, we don't have these limitations on the building zone anymore. The limitations are put on the actual lines. So I will say that, okay, this line here can carry 1,000 megawatts. At the same time, I will inform the system how much of trade from A to C will actually go to this line. And I will do the same for B. If I trade from B to C, how much will go with this line and how much will go with that line. So I will tell the female platform how the power will flow in physically in the system. So I'll give real grid information to the system. That means that when you have the market clearing in A, for example, it knows that, okay, I will send that many megawatts from A to C. That means that I will have some megawatts there, some megawatts there, some megawatts there. Please make sure that no more than 1,000 megawatts go on this line, and on this line, and on this line. We have physical capacity in the system. We have realistic capacity in the system. That means I can get all capacity to the marketplace. Of course, there are some more complexity behind that statement, but that's the way the flow-based system works. So we can give more capacity, and this is being implemented now. We have a lot of discussions with the stakeholders, big meetings on the Nordic level, and in Sweden they are not very pleased with this because the export capacity from the southern Sweden increases, so they can't have all that nice cheap electricity any longer. That means that they will have to pay more for the electricity. But on the other side, in the southern part of Norway, where we usually have had high prices lately, we have more import capacity both from the north of Norway and also Sweden. So nicer prices in southern Norway. That's not something that they are very happy about in Sweden. So there was just the other day a big article about how people are going basically to die in Sweden because of flow-based market companies. It's weird. It's really weird. And also at the same time, you have more power flowing, electricity flowing from the north and south in Norway, causing lower prices in the south, but higher prices in the north. So today yesterday was an article in Nettavisen about how this is going to be unacceptable for the northern part of Norway. So basically, we provide more capacity to the market, more flows going around, leveling out prices. Some will have to pay more, some will have to pay less. Those that have to pay more are not pleased, and there's complete silence from the other side. So yeah, this is something that is brewing right now, and it's going to be very interesting to see what happens further. But if you have any questions, just come on with it. Yeah.
When you say pay more, is it a lot more? When you say pay more, is it a lot more? I mean, your individual consumers really see it, or is it
that depends.
Exaggerated?
It's very difficult to say because right now we have a certain situation. We are just more or less coming out of the energy crisis, and we had this simulations ongoing for the period of the energy crisis. And in that situation, yes, a lot changes. We, for example, saw that in some part of that period, there was a 30-35% increase in AC3 prices and a 12-15% decrease in the prices in NO1, NO2, and NO5. So that's very particular to that situation. So we also had a situation where the capacity between NO1 and Sweden was set to 0, and we had an enormous what's called inundation in Norway, right? A lot of water pouring into the reservoirs. So in NO1 you had a really high pressure to run your generators. You couldn't run that power to Sweden, right? Because you had 0 capacity. So, and you couldn't really run it to NO2 either, which was kind of limited by other reasons. So the prices in NO1 was extremely low. In that situation, when simulated, it would have increased the prices in NO1 by 1,600%. From 1 Norwegian line to 2 Norwegian. That's from 1 euro cent, from half a euro cent to 1 euro cent. It's kind of I a little bit more than that. It got to 4 euro cents a bit. So it's that much from half a euro cent to 2 euro cents. Is that a big increase? Percentage, it is a big increase, but in absolute measures, it's not. So it depends what they're looking at. What are the basics you're looking at? Where did it start? It can be much, it can be little.
When me and Mette, we were in this grid commission, one of the things was how costly it is to build grids. But this seems like a way to get free grid, in a sense, free grid capacity, in a sense. How much grid capacity is are you able to find in flow base?
I can't give you a number because, we have 12 bidding zones in the Nordics, and there are interconnections between all of them. But what you do is basically say to the market that you decide whether you want to buy the capacity. So on some borders there will be less capacity due to that, the other borders have more capacity. So due to this transit flow, you will be limited somewhere that you are not limited today, but you will have higher capacity somewhere else that we are not limited today. So we are limited today, sorry. So it's very hard to say what is the number. Of course, it's possible to compute, I guess, 27 dimension cube and tell you volume, but it's meaningless. It's meaningless. But the opportunity for trade is much higher. So you can have much more trades in the system. Yeah, what's time now? Okay, 15 minutes left, right? Yeah. Then I won't go into this one, just saying that the price, the way prices are formed in NTC and in flow-based is of course different, and we will certainly change the pricing mechanism, because now all of a sudden the price becomes dependent on the PTFs, basically the way power is physically transmitted to the grid. As of today, the prices are only influenced by whether a bidding zone is constrained, export constrained, or import constrained. So that will change. We can look at this later. And this is just an example of a flow-based solution. Yeah.
So how much of this information will be available? Because now you can see the NTC capacity.
Yeah.
So
Yeah.
everybody can build a model,
Yeah.
which is simplified because you don't have the bids and so on, but you can make assumptions.
Yeah.
So, but the network model
Yeah.
in the present system is possible to build.
Yeah.
So would it be enough information provided to everybody that you can actually do the same, so that you know the PTFs,
Yeah.
the remaining whatever it is, REMs and
Remaining available margin.
yes,
Yeah.
remaining available margin.
Yeah.
So
Yeah, it should be, because we have this consultancy company, not ours though, it's out there somewhere, Volume, it's a Norwegian company, Volume something. And they are doing this for Europe already with flow-based, and they don't find it that hard. Just like NTC, they can forecast prices. So it should be. And going to this one, what the market will see is basically all the PTFs. Here I have this 3-node system I just showed you. This one. I translated that system to real information, right? But the system, the real system is much more complex. It has a lot more lines and a lot more columns, because here you see that we have one column for each bidding zone. I had 3 bidding zones there, right? And for each of those bidding zones, I have an impact on each of the lines, which we call critical network elements. So if A inject 1 megawatt, sending it to C, 33% of that flow will go from the line A to B, 33% will go from the line B to C, and 67% here from A to C. That translates to 33% from A sent to C with others B and go to C. So A, B, and B to C, and 67% goes away. That's the type of information. And in reality, we have a lot of lines being monitored. So there are like 120 of those lines each hour in the Nordic. We also have a lot more bidding zones. We have 12 green bidding zones, and we have 15 virtual bidding zones that are monitored at the same time. And those virtual bidding zones are there for the HVDC lines, for those ones. So it's a big matrix, and all that information is being made available to the market participants. We will provide a year ahead model and later a month ahead model, and currently we are simulating this type of market clearing with the Euphemia algorithm together with bids, and we publish all PPLs for all hours. It is a continuous process. And the RAMs, that is the remaining available margin, is basically the capacity of each individual component in the system. And what I've done here is basically, this is my matrix, this is the market information, and these are bids provided to each of the bidding zones. And when I apply these bids, of course I have numbers for those lines. With these matrices, I can clear the market and get to the net positions and the prices and the shadow prices on the limiting components and the lambda, which is the price in the what we call the next one. You can look at this later if you are interested and see if you can be complete everything. You should be able to do that to these very simple operations here on costs. So, 10 minutes left. I also want to talk to you a little bit about the balancing markets, because the balancing market is kind of the core of the TSO business, the small private business. That's where we are. Others, besides providing capacity to the day and info market, this is where we do the real-time balancing of the system. So if there is an imbalance in real time, that means consumption is not exactly equal to production. We have a problem that we need to solve, so we need to increase production in that situation. And the balancing market is what we apply. The BPRs, or the balancing responsible parties, which are market participants, they are doing their balancing in the intraday time plan, right? But I explained earlier. But we are doing the balancing in the real time. And if a BRP is not balanced after the intraday market, the system operators take over, right? So we do the balancing for them. It's more expensive in the balancing market, so it's a good solution for anyone, but we will do it. And then we will invoice those BRPs for the balancing services that we provide. There are two reasons why we have this balancing exercise. The first of it, the most important basically, is to manage the real-time frequency, right? What we want is a frequency at 50 Hertz. That's the European system. That's something that the economists doesn't understand that good, but it's something about perturbations and so on in some way. But we want a frequency of 50 Hertz, and we can allow it to increase to 50.1 Hertz, and we can allow it to drop to 49.9 Hertz. Within that span, we are happy as we so. We know the system is balanced. And what does that mean? That means that if the frequency starts to increase above 50 Hertz, that means that there are too much generation in the system. So then we need to do something. So when it goes beyond 50.1, we have to level off generation or have some consumption increase. If it drops below 49.9 Hertz, we know that consumption is too high. We lack generation, so we need some generator to start pumping up, or we need to reduce consumption in some way. So we have agreement with different stakeholders on how we can do this, and we have these markets where we actually trade in that kind of capacity to do those kind of things. The market itself is, as I said, it's kind of split in two. At first, we have a balancing capacity market, and that is run before the day-ahead market. So here we are buying reserves. We have a process for deciding how much reserves we need at each moment in time, and we will buy those reserves here. It's not for sure that we need those reserves, but we need them present. That means that I need some generator be prepared to run if I need them in the balancing time frame. I need also some consumers to be ready to scale down or up, if possible. So I buy some reserves here. But I also want to make sure that I'm able to actually activate those reserves, right? So I also need to consider, okay, how does my grid look? Can actually is there any risk that the day-ahead market use all accessible grid capacity, so that when I want to activate my balancing reserves in real time over here, there's no grid capacity available. That gives us overloads in that case, and we don't want that. So we have to compute, okay, when I have bought these reserves here, how much grid capacity do I need to reserve to make sure that I can actually activate those reserves in real time?
Is this the one the regulators want to compromise?
Exactly. That's where the compromisation comes in. So currently there are no compromisation. We have a market-based procurement of reserves, and we have a rule saying that we can apply up to 10% of the transmission capacity can be used for these purposes, so that it's stable done. In reality, we are buying in one bidding, so we can buy up regulation and down regulation. That means a generator up and a consumer down, something like that. And we don't know what we are going to activate. So in reality, there are kind of an infinite amount of different activations of activation, generation up and consumption down.
Who are those players in that capacity model? Is it the power intensive industry that reduce consumption? Then only hydropower on generators?
I think there are mainly hydropower at least.
Okay.
Yeah, I have seen some of those lists, and they are hydro producers. Yes. Yeah. So the market participants has to consider whether should I withhold some of my capacity and sell it in the balancing market instead of going to the day-ahead market in frame market. Yeah.
You recently released this calculator to incentivize others and other hydropower producers to come into this reserve market. So it should be easier for consumers or other producers to come in.
Yeah.
But how is the cooperation between DSO, TSO if it's reserve is on a different rate?
I don't know how much. I can't answer on DSO, TSO.
Okay, because it looks very attractive when you go into look at the calculator with a battery. Maybe you think, oh, I can participate. It's super easy. But then maybe it's not so easy.
No. I think that having it. I know, for example, that I think Tilburg, one of the Norwegian power suppliers, are actually trying to establish that kind of service where you can you can let them trade the battery charges on your EV, for example. They can use that in the balancing market as a tool, right? And those kind of things. So there are aggregators there. We need aggregators to make this work. We need aggregators to have bigger volumes. Yeah.
It's not so easy when we
It is.
Coordination between different operators.
But I can't answer much on DSO, TSO issues. It's not that's unfortunately not on my table. Unfortunately not on my table. Yeah, good. Then I will quickly go to the last one here. So we have the balancing market where we buy reserves. Those reserves are being held back from the day-ahead market together with some capacity, transmission capacity. And I will skip this one. I move directly to this one, which is the last one. So now I'm in real time, right? And it seems like we have this MARI platform, this Castle platform, and we also have FCR activations. So FCR, that is frequency containment reserves. It's not a market-based thing. It's something that all generators, consumers, or big consumers, big generators can actually add to. It's an automatic process, and the FCR is meant to when for example the frequency is dropping. These reserves are really quick on the spot to contain the frequency, so it doesn't drop further. It's just stop the movement. And then we have AFR reservations, which are frequency restoration reserves. And these are automatic. They are responding really, really quick, 2 to 5 minutes. These ones come in and replaces the FCR activation. No, basically replace the FCR activation, and we'll try to take the frequency back to 50 Hz. These ones are also quite expensive, so after a little while, we can activate manual reserves. Those have a response time on 12 minutes, and that's basically that they will basically replace these automatic reservations or reserves rather. And the thing is that these are not markets going from one market or these are not kind of consecutive processes. It's not like we start with FCR, then we go AFR, then we go MFR. These are happening all the time at the same time. So each moment in time is a moment where we do balancing. So at the same time as FCR is being activated, something we can also see some AFR being activated to replace some earlier FCR activity, and at the same time there will be an MFR kind of responding to that one. Yeah.
Can I ask you?
Yeah.
So there at the start of capacity calculation, that's balancing capacity.
Yeah.
And then when you get further into the platforms,
yeah,
that's balancing energy, right? That's two different things.
Yeah. This is transmission capacity. Transmission capacity. Yeah. And what we've started off with is by balancing capacity. So it's still not energy. But this, when we come here, it's energy. Yeah. If that was what you meant. Yeah.
I have a core piece of
yeah.
Good.
So this is activation of the energy grids. Yeah. So these things are working constantly, and we can also move in between those market with something we call direct activation if we need to balance off an overload in the system. And we can also use these markets to manage an overload on a single line. Fine. If you have an overload in that direction, I will try to have the generator there move down, and then I will try to buy up on the other side. So basically taking away the overload. That's direct activation. It's a different thing inside this one. So this is a quite complicated system. And there is obviously multi-platforms, there are auctions and there are pricing and all these things are going on. That's almost to the spot, right?
Yeah, so I think you will have a couple of questions. Thanks a lot for anyone in the audience? Or anyone on the web? So I'm thinking, where is the inertia here? So is this where you need the inertia, or?
And inertia is, yeah, that's a good question actually. I don't know.
No.
It's somewhere. It's somewhere. We need inertia. Yeah, that's what you're. I guess also that it's not that big of a problem in the Norwegian system or the hydropower.
Yeah. Thanks a lot, and thanks for all of you coming here for the seminar today. We're very happy that all of you could come and speak for us today. So thank you again. Oh, yeah, but I think